Investing your money for long-term growth can be a great way to build financial security and increase your wealth. However, it can be hard to know where to start when it comes to investing your money. In this video, we'll explore 5 of the best ways to invest your money for long-term growth. From stocks and bonds to real estate and more, we'll cover all the best options for investing your money for the future. So before we start, please subscribe and hit the notification bell to stay updated on our future content. 1. Index funds. Index funds are a type of mutual fund that is designed to track the performance of a specific market index, such as the S&P 500 or Dow Jones Industrial Average. They offer investors an easy and low-cost way to gain access to a wide variety of stocks and bonds. Index funds are typically more diversified than individual stocks and have a lower risk profile than actively managed funds. When you invest in an index fund, you're essentially buying shares in all of the companies in the index. The returns you receive will depend on how those companies perform. One of the advantages of investing in index funds is that they are relatively low cost. They are also easy to set up and manage since they don't require as much research and monitoring as other investment options. In addition, index funds can provide investors with long-term growth potential since they are typically diversified across many different types of securities. Investing in index funds can be a good option for those who don't have the time or expertise to actively manage their own portfolios. However, it's important to note that index funds may not always outperform the broader market, so investors should do their research before committing to a particular strategy. 2. Exchange-traded funds, ETFs. Exchange-traded funds, ETFs, are investment funds traded on stock exchanges that track a particular index, sector, commodity, or basket of assets. ETFs are considered a cost-effective and convenient way to gain broad exposure to the stock market as they are highly diversified, low cost, and require minimal management. ETFs often track the performance of major stock indices such as the S&P 500 or the Dow Jones Industrial Average, but they can also be designed to track the performance of a particular sector or even invest in a specific group of commodities. When investing in an ETF, you will receive an equal proportion of all the underlying stocks or assets that comprise the fund. Additionally, unlike mutual funds, ETFs can be bought and sold throughout the day and there are no minimums for investing. This makes ETFs ideal for those looking to invest smaller amounts or take advantage of short-term trading opportunities. Despite their advantages, there are risks associated with ETFs, including tracking errors and liquidity risk. Tracking errors occur when a fund fails to accurately match the performance of the underlying assets, and liquidity risk occurs when the fund is unable to meet redemption requests at the prevailing market price. However, these risks can be managed by ensuring proper research and analysis are conducted before investing in any ETF. 3. Individual stocks. If you're looking for a more hands-on approach to investing, individual stocks may be the right option for you. Investing in individual stocks is a good way to target specific companies that you believe have growth potential. This can be a risky option, as stock prices can be volatile, but done correctly, it can be a great way to increase your wealth over time. Make sure you do your due diligence and read up on the company's financial statements and business model before deciding to invest. Once you've chosen the right stocks, you'll want to keep an eye on them to ensure they're performing as expected. If you're interested in investing in individual stocks, there are several online brokers available who offer trading services at a variety of price points. You should also consider speaking with a financial advisor or investing expert to get advice on how to properly manage your portfolio. Individual stocks can be a great way to increase your wealth if done correctly. Make sure you do your research and have a plan in place before investing, and you'll be well on your way to financial success. 4. Real estate investment trusts, REITs. Real estate investment trusts, REITs, are a form of collective investment that provides investors with access to professionally managed portfolios of real estate assets. REITs allow investors to diversify their portfolios and benefit from the potential of earning income from owning real estate. REITs are similar to mutual funds in that they are professionally managed, diversified investments. However, REITs focus on real estate-related investments, such as office buildings, apartment complexes, retail centers, and more. One of the main advantages of investing in REITs is that they provide an opportunity to generate passive income. Because the properties owned by a REIT are managed professionally, investors don't need to worry about the day-to-day management and upkeep of their investments. REITs are also an attractive investment for those who don't have the resources to purchase individual real estate assets directly. They allow investors to participate in real estate markets without the hassle of dealing with tenants and property repairs. However, it's important to remember that REITs are subject to the same market forces as any other security and can go up or down in value. Therefore, investors should consider their risk tolerance and financial goals when determining if REITs are right for them. 5. Savings bonds. They are government-issued debt securities that are backed by the full faith and credit of the U.S. government. Savings bonds typically offer higher interest rates than other forms of fixed-income investments, and they are considered one of the safest investments available. There are two main types of savings bonds, Series E and Series 1. Series EE bonds are issued at a discounted rate, and they pay out a fixed rate of interest over a set period. Series 1 bonds are inflation-indexed, meaning the interest rate is adjusted each year based on the inflation rate. Both types of savings bonds offer a range of maturity periods, from 1 year to 30 years. The longer the maturity period, the higher the interest rate will be. However, you cannot cash out a savings bond before it reaches maturity without paying a penalty fee. Savings bonds can be purchased through most banks, financial advisors, or through the U.S. Treasury's website. If you're interested in investing in savings bonds, you should speak with a financial advisor to determine which type of bond is best suited to your goals and financial situation. And that's all for today's video. Thank you for watching. I hope you found the information helpful and informative. Remember, investing your money wisely is an essential step towards securing your financial future. If you have any questions or comments, please leave them down below. And if you want to learn more about personal finance, investing, and wealth building, make sure to subscribe to our channel and hit the notification bell to get updates on our latest videos.